Hey guys, welcome back to the Financial Freedom Channel. So today I want to talk about buying a dollar for 50 cents. So Warren Buffett, when he was 11 years old, he realized three things about how to grow wealth. There are three things that need to happen in order to have a tremendous amount of wealth. The first thing is you need to start with something. You need starting capital. And that's why Warren was so big into starting all kinds of businesses from a very early age. He knew in order to end up with a bunch of money, I need to start with something. I need to start with some seed capital. The second thing is, what is your rate of return? How quickly can you get those doubles? So you start with $1,000. How quickly can you go to 2,000, to 4,000, to 8,000? That's your rate of return. So at 26%, so say you're getting 26% on your money, you're going to double your money every 3 years. And that's kind of what we're going to be talking about in this episode. But the last one, the third factor, is the length of your runway. How long are you growing your money for? So, funny thing, at 11 years old, Warren Buffett was actually looking at life expectancy tables. He wanted to know, okay, so I'm 11 now. How long am I going to live? How long am I going to be able to compound my wealth? It just kind of blows my mind that he was looking at life expectancy tables at 11 years old. So those are the three factors: starting capital, rate of return, and length of runway. Today I want to dig into the second one, rate of return. So I really want to drill this concept into my brain, this idea that, in order to get wealthy, in order to grow my wealth, I don't need to do it all in one step. In fact, it could be quite dangerous and likely catastrophic to try to do it in one step, to get rich fast. The idea that I just need to find a company where I can put 50 cents in today to get $1 back 2 or 3 years from now. We're going to be talking about the 3 years from now in this episode. So it's easy to swing for the fences, guys. It's easy to look at a company like NVIDIA that has 11x return over the last 3 years and think, oh, I can find a company like that. I can look for a company that looked like NVIDIA 3 years ago. I can find a small marijuana company. I can find a blockchain incubator. I can find the next, lithium technology breakthrough that's going to take the electric vehicle market into the stratosphere. I can find those. But here's the thing, Warren Buffett, Monish Pabrai, all these value investors, this is a proven methodology for growing wealth. And, there's a reason Warren Buffett is the richest man in the world. This system of finding companies where you can spend 50 cents today, get $1 back 2 to 3 years from now, this is the most proven investment system that I've seen. So I need to drill that into my brain, not to swing for the fences, not to, put thousands of dollars down on these high-risk plays where the probability is that I'm going to lose all my money. So it's these companies where it's heads I win, tails I don't lose, like Monish Pabrai talks about. It's asymmetrical upside for a minimal downside. Those are the kind of deals I'm looking for. So I got curious yesterday. I wanted to know, from today going back 3 years, how many companies could I actually double my money on over the last 3 years? So I looked at the price today, and I looked at the price 3 years ago for companies that had over 50 million in market cap. So these are companies that aren't super small. 50 million is still pretty small, but I wanted to get rid of all those really small companies because those are just generally too risky. So, the analysis won't be perfect. So there's companies that were around 3 years ago that I could have invested in that aren't around today. And those aren't going to show up in my numbers here. There's companies like Whole Foods that was around 3 years ago, got acquired. That's not going to show up in my analysis. Fiat Chrysler, actually a couple of years ago, they spun off Ferrari, which was great for investors, but it's not fully, isn't fully reflected in the stock price today versus 3 years ago. So it's not a perfect analysis, but I thought it was interesting. So I went to the UC Berkeley Library, Business Library, pulled up Capital IQ, which is a fantastic platform for analyzing all kinds of these financial metrics. And I was looking at companies on any U.S. exchange, companies that were greater than 50 million in market cap. So there were a total of 8,827 companies that met this criteria. Price today, greater than 1 cent. Price 3 years ago, greater than 1 cent. Available on a U.S. exchange, greater than 50 million market cap. Now, the number of companies that doubled in price over the last 3-year period was 1,063 companies out of 8,827. So I have a 1 in 8 shot of doubling my money over the last 3 years. 1 out of 8 companies. Those are my odds. If I were to just throw a dart against a ticker symbol, I had a 1 in 8 shot, of doubling my money in 3 years. Now that's not finding a needle in a haystack, guys. That's, those are decent odds. So, while there are plenty of these doubles out there, there are plenty of these doubles to be had, as is shown by this 1 in 8. The key is to find the ones where you can explain to an 8-year-old why the company is almost certain, or I should say why the company has a pretty high probability of doubling at least in the next 3 years. Those are the companies we're really after, guys. It's the companies where the odds of growing your money are much greater than the chances of losing money. So thanks for being here today, just helping me drill that into my head. That's how I need to approach growing my wealth into the future. That's what Warren Buffett did. That's a really sensible way to invest, as opposed to speculating or gambling on, the hot next thing where the companies aren't actually making any kind of money. It's a purely speculative gamble play. So anyway, again, thanks for being here, guys. Hit that subscribe button so you catch my next video. And see you soon.